In May 2026, the federal budget did something that hasn't happened in over 25 years. It fundamentally rewrote the rules of Australian property investing. The 50% capital gains tax discount replaced. Negative gearing on established properties quarantined. Discretionary trusts hit with a new 30% minimum tax. But one structure walked away almost completely untouched. SMSFs. Today we break down why. Let's start with the headline change that every property investor needs to understand. From the 1st of July 2027, the 50% capital gains tax discount on assets held longer than 12 months will be replaced for individuals, partnerships, companies, and most trusts. The new system combines cost-based indexation, which adjusts your purchase price for inflation, with a 30% minimum tax on the net capital gain. For most investors, this is going to result in significantly more tax on property sales than under the current rules. But here's the critical detail. SMSFs are completely exempted from this change. SMSFs and other complying superannuation funds retain their existing 1/3 capital gains tax discount on assets held longer than 12 months. So while a property investor in their personal name will pay tax on a much larger portion of their gains from July 2027, an SMSF holding the same property will continue to pay tax on only 2/3 of the gain. Over a typical 15 to 20-year property hold, this difference can amount to hundreds of thousands of dollars per property. Now let's talk about negative gearing. The budget did not eliminate negative gearing, but it has fundamentally restricted it. From budget night, the 12th of May 2026, negative gearing on newly purchased established residential properties is being quarantined. What that means in plain English is this. If you buy an established rental property after budget night and it runs at a loss, you can no longer offset that loss against your salary or other income. The loss can only be offset against rental income from other properties, or against future capital gains on residential property. Effectively, the negative gearing tax benefit on established properties is being closed off. New builds remain eligible for full negative gearing, which is part of the government's strategy to encourage new housing supply. Properties owned before 7:30 p.m. Australian Eastern Standard Time on the 12th of May 2026 are grandfathered. Existing investors who already hold property are not affected. Full restrictions on new purchases apply from the 1st of July 2027. And once again, SMSFs are excluded from these changes. SMSFs can continue to use negative gearing strategies on property within the fund. The same applies to widely held trusts. The third major change is the introduction of a 30% minimum tax on discretionary trusts from the 1st of July 2028. Discretionary trusts, also known as family trusts, have been an extremely popular structure for Australian property investors for decades. The flexibility to distribute income to different family members in lower tax brackets has been a major advantage. The new minimum tax effectively prices that flexibility out of the market for most family trusts. Trustees will pay a minimum 30% tax on trust income at the trust level, with credits flowing through to beneficiaries. There is no broad grandfathering for existing trusts, which is going to force a major restructuring conversation across Australian property investing over the next 2 years. So why have SMSFs been left untouched? The political answer is straightforward. The government wants to encourage retirement savings, and SMSFs are technically a retirement savings vehicle. Attacking SMSF tax treatment would be politically difficult and would undermine the broader superannuation system. The practical result, however, is that SMSFs have suddenly become one of the most attractive structures for property investing in Australia. The 1/3 CGT discount is preserved. Negative gearing strategies remain available. The minimum trust tax doesn't apply. Personal investors looking at the new landscape are increasingly asking themselves whether the limitations of SMSF property investing, limited borrowing capacity, single asset acquisition rules, contribution caps, are worth accepting for the substantial tax advantages. Let's run through the math quickly. Imagine you buy an investment property for $700,000 and sell it 10 years later for $1.2 million. Capital gain of $500,000. Under the old rules, with a 50% discount, you would pay tax on $250,000 of that gain. At a top marginal rate of 45% plus Medicare, that's roughly $120,000 in tax. Under the new personal name rules from 2027, with cost-based indexation and the 30% minimum tax, the same sale could trigger tax closer to $170,000 depending on inflation rates over the holding period. The same property held in an SMSF, taxed at 15% with the 1/3 CGT discount, would generate tax of roughly $50,000. The structure you choose now will materially affect your wealth at retirement. So what should you actually do? 3 priorities. First, if you already own investment property in your personal name or in a discretionary trust, do not panic. Existing properties are grandfathered for the negative gearing changes, and gains accrued before July 2027 retain the 50% CGT discount on a prorated basis. Sit down with your accountant and model your specific position. Second, if you are considering new property purchases in 2026 or 2027, the structure decision is now more important than the property selection. The same property can produce dramatically different after-tax outcomes depending on whether it sits in your personal name, a trust, a company, or an SMSF. Third, if you have a discretionary trust currently holding property or other income-producing assets, you have until July 2028 to consider restructuring options. That is not a long window for a complex tax decision. Every property investor in Australia needs to engage with these changes urgently. The window between now and July 2027 is the most important tax planning period Australian property has seen in a generation. Get advice. Run the numbers. Make decisions. If you found this useful, hit subscribe. We break down Australian property and tax changes every few days. And if you want to know exactly how to restructure your portfolio before 2027, click the video on screen. See you next time.